75 to $100 worth of money, to
Yep.
then I net close it,
Yes.
you know. So, but yeah,
Yeah.
it's
Yeah, you gotta hit while the iron is still hot, and this is a game of. I don't know that anybody is an expert at this. You really cannot time the market, but time and time again, I always say that when you see the profit, you take it because it's not going to be there for very long.
right,
Or if you wait, if you get your 25, 30 cents and you say, I'm gonna hold out to 40 cents or 50 cents, most of the time you give back that 25 and some. You take small wins. At least you have a strategy. You got to have a strategy on that. Yeah, I'm usually trying to make somewhere around 2,500 to 3K. And I'm also looking for about 40 weeks, of that
right,
on average. Sometimes a little bit more, sometimes I give back.
right.
But as long as I can net, somewhere between 100 and a quarter mil every year, that's good.
Just doing SPX.
Yeah, that's all I do.
Well, well,
Yep.
I gotta step up my game a little bit at some point then. But
Well, slow but sure. Slow but
yeah,
sure. Yeah.
yeah,
And there's a path to that. The good thing is that there's a path to that. It's consistency. It's not big backs. It's not one of those feel good kind of deals. It's boring. It has to be boring. That's the deal. If you
right.
make it if you make it interesting, then something's gonna blow up at some point. My game plan is actually spending less than 10K every day. That is enough to make me. That is enough to 10x that money in 1 year by
Right.
trading every day, no more than 10K. So whether you have a million, whether you have 2 million in your account, there are other strategies that will make you a lot more money with the other $990,000. But anyway, there's ways to obviously arrange that, and I've talked about it in the past. I'm going to talk about it a little bit here in a minute. So capital efficiency is a big deal. Capital efficiency is a big deal. If you can learn how to manage a lot of money or a little money, you will also learn how to manage a lot of money. That's important. Well, welcome everyone. This is Saturdays with Eddie. Today is Saturday, January 18, 2025. It's the first one of the year, and hopefully we're going to try and do these every couple of weeks. The purpose of this is just to build camaraderie and community. What we do here is just talk options, ways to improve our trading styles, ways to make more money, and that kind of stuff. So that's what we're all about. We are going to try and draw a plan for 2025. And the way to do that is kind of look back at history and understanding what we know, what we've gone through, what we've all experienced. All of you here in the room are experienced options traders, so you've been there, around the block. You've traded your calls, your puts, your spreads, your strangles, your straddles, your condors, all of that good stuff. We're past the basics, even though we're always happy to talk about basics, every once in a while. So today we're going to keep it short, but right under about 30, 45 minutes maybe. But the idea is to look back, reflect, and see what our capabilities are, what we know, and how can we use that knowledge and the experiences over the last few years or however long we've been trading to guide us in 2025. We have one objective, and that is to trade better, maybe even keep more of what we make, because we make a lot of money and we lose a lot of money. But how can we keep more of what we're making, and how can we make it grow? How can we help that grow? The idea here is to be consistent and to have a why, but we are also going to be adding another dimension to it. I think that is important because first off, we've been spending a lot of time learning how to do this, learning how to do options, whether it's whether we're talking about spreads or calls or puts. That's we spend a lot of time learning the basics. But now that we have that, or we are still in the process of doing that, how can we add to our repertoire? How can we add some other things like growing the portfolio? A lot of us are somewhere in the retirement age. I'm retired myself. Uh, we've got dual purposes, right? We've got dual action. We're making regular income. That's feeding our weekly paycheck, right? So it's one source of income. It's one side hustle, if you will, if you want to call it a side hustle or anything like that. And then there's also the growth part of it. So we want to make sure that we're not just like a hamster in a wheel trying to just spin it just to survive, go on to the next step. I look at it as being able to trade for your weekly paycheck. That's number one, and that's a good goal. But also being able to fund your future, if you will, whether you're saving for an investment, whether you're saving for a trip, whether you're saving for retirement, you're adding to your, separate IRA, your Roth and stuff like that. How do you position yourself to do that intentionally? Not just by chance, but intentionally. That's the name of the game. To do that, we first have to look at the numbers and see what are the possibilities. We know that in order for you to make about 2, 3 thousand every week, you don't need more than 10K on a daily basis. Actually, 7, 5 maybe. If you're doing 5 point wide spreads, you're probably exposing around maybe 5,000. If you're doing 10 point spreads and you're doing 10 of them, you're probably exposing about 10K. And that's usually enough to get you into that space of between 10 to 20K. Personally, I expose about 10K. At any one time, I expose about 10K. That's my usual capital exposure. And I'm usually trying to make about $1,000 a day or so, give or take, right? That's what I'm trying to do. And with that, because I don't trade every day, my net is usually somewhere between 3 and 4. Sometimes it's usually zero. But that's what I'm trying to do. And believe me, I don't spend more than 10K. I don't expose more than that. So is it because that's all I have? That answer is no. What do you do with the rest? Yeah, what do you do with the rest? Do you just let it sit there? The reason I'm asking about that is because you all know about the PDT rule that says that if your account falls below 25, then you can only trade like maybe 3 times, yeah, every 5 days, round trip, excuse me. How do you take advantage of the rest of the money that you are not using, that you don't even need for your daily trading and for your weekly paycheck? Remember, you've only allocated 10K out of your total portfolio. That's what if on your worst day, if you drop that 10K, that's a really bad day because you just lost your job basically. But let's say your job is 10K, that's all you use. It's a good thing to protect that because that's giving you every day, every week. The rest of the money, and especially for those who are managing an IRA or a brokerage account that they can't get to that money before 59 and a half, what do you do? Last year, we talked about the path to 3 million, and we said, why 3 million? Why did we talk about 3 million? It's because a million is old. A million is old. It used to be that if you got to a million, you made it, you had it all set. 3 million is the new number that I think, and that a lot of people are beginning to think, is the actual number that you now need in order for you to actually just be comfortable. Really easy, be comfortable. And it's not just about the exponential number, point of it, but if we do some math and there's some science behind it, most most financial analysts will say that if you have a well invested portfolio and you are following, or your portfolio is matching or somewhere plus or minus 10 to 12%. That is what the S&P does. So if you are well invested, and we're going to call that passively invested, maybe you had some growth stocks, you had some income stocks, some dividend paying, and you had some bond mixtures or something that is cash like. If you just mimicked the S&P, you would probably average about 10 to 12%. So if we take $1 million and ask what is 10% of $1 million, it's about what, $100,000, right? So if you are in your retirement and all you're looking at from your portfolio of 1 million, you're looking about $100,000 a year. But if you were to start withdrawing 100,000, your account would start dropping pretty quickly, because it's not always that we hit 10, 12%. Sometimes we hit 20% or 23%, as the case may be for last year. There are times that we hit minus 20%. right? Like a few years ago. So what you want to do is you want to follow the FIRE principle, the financial independence, retire early. We've talked about that a few times, but you want to get that into that 4% withdrawal rate. So imagine if your money is earning about 10 to 12% and you're withdrawing about 4%, means you'll never run out of money. 4%, what is 4% of 1 million? So I'm going to do my math here again. 1 million times 4%, it means that you're making about 40K. Is that right? Is that enough to help you to live comfortably? Not today. Well, maybe today, but not for long. 40,000 with the rate of inflation, with everything going on, with your lifestyle, the way that it's been going. Realistically, most people do not reduce their spending in retirement. Things just change. Most people don't change drastically in their retirement. Some of the major things that change in your retirement are maybe you've paid off your house, maybe you've paid off your cars, maybe you've already paid, your children's education, and so you don't have those expenses, and that's good. But now you've got new expenses like traveling, you've got hobbies that are expensive, you've got families, you've got people that you're helping out. Those new expenses can add up, right? So you want to kind of maintain your current lifestyle, if not make it better, right? We always want better. We don't want worse. We want better. So to that point, let's pick my 3 million here, number here, and I'm going to say 4% of 3 million is about 120,000, right? So 120,000. So if you want to put in the chat and let me know that 120K net from your investment is okay, go and say yes. Yes to 120K out of 3 million, and that's 4% of your that's a 4% return on your investment. You're picking up 4%. If your portfolio is giving you about 11, 10 to 12%, then you're not withdrawing all of that. You're only withdrawing about 4% because you can. That means you'll not run out of money, and you're still paying yourself 120K. I think that's comfortable. So our path to 3 million was an attempt to see how do we get there in addition to paying us every week, right? So every week your 10K, we're going to call it your job, is giving you, 1,000, 2,000, whatever. It's paying you. But there's going to be a time where it's going to get old, right? It's going to get old. You don't want to be 62 years old or oh, well, actually, that's pretty young. You don't want to be 70 years old and you're trying to wake up to get into the stock market. Yeah. You don't want to do that. You want your money to be working for you. Either you've got investments that are making money while you sleep, you've got some index funds that they just, it's payday today, dividends, whatever. Those are working for you. That's how you ensure or assure your retirement, because you don't want to have to think about on your vacation, on your month-long vacation, for instance, you don't want to think about, oh my goodness, this whole month I can't make a single cent. How am I going to pay for this? Or next month I'm going to have to come in and try and work twice as hard because I wasn't in the market for a full month, right? That gets old. You want to maximize right now and prepare for later that money to help you. So that's why we talk about what's the rest of the money doing in your account and how can we use it to help you. So that path to 3 million is one that we talked about extensively. So I think about 2 or 3 times that we said you need to have a plan. 3 million is just one number. It can be 10 million. It can be 1.5 million, right? For example, if your target is 60K, every year, then 1.5 million is your number. Basically, pick up a number that you want as your net, 4%. That's the 4% that you want. So if you pick up your number and say that I would like to say, and let's do an example here. Let's say I want to make 50K, or I want to withdraw 50K from my investments every year. So what is the number of the portfolio that I need? How do you decide what that number is? The math is pretty simple. It's 50,000 divide by 4%. So if you pick up your calculator and you type in over there 50,000 and you push the divide key, you put 4 and then you push percent, that ought to give you 1.25 million. All right, let's do another number here. Let's do 80,000. So you want 80,000, right? So 80,000, I typed in 80,000, pushed the divide, pushed 4, pushed percent, that number is 2 million, right? So 2 million. So if I want net to collect 80,000 from my investments without it going down significantly or even at all, if I want 80,000, then I need a portfolio of around 2 million. I'm assuming here that I am keeping up with the S&P 500, which does 10 to 12% a year on average, right? 12 to 10 to 12%. So assuming that your portfolio, and I'm going to repeat this over and over again, assuming that your portfolio is keeping up with the S&P 500 and doing 10 to 12%, then you are eligible to have a withdrawal rate of about 4%. And that means that your portfolio is not going negative. It is still continuing to grow and it's still paying you for as long as the stock market exists. Right? So it's not a one-time thing. It's year after year after year. And this is where we're walking to. So if by 65, let's call 65 the retirement age, or whenever, you can retire anytime, right? I did not wait until I was 65 to retire. I retired in my 50s, right? So once you get there, and that's the objective, get there as soon as you can, or whenever, you can go slowly or whatever. But once you get there, then you can say that you're comfortable and you need now to be well invested. So the question is, what is being well invested? So in the path to 3 million, what we talked about is how can we beat the stock market? How can we beat the S&P? How can we get better than 10 to 12%? And we looked at index funds, specific ones that give us even better than 10 to 12%. We looked at some that are giving us 35%, right? Now, does that mean they give us 35% every year? No. No, that's fake. It's not fake. It's just not sustainable. So what you do is you want something that gives you a lot of money most years. But we found stocks that on average over the last 10 years have averaged 18 to 20%, right? And specifically ETFs, not stocks, ETFs. You don't want to invest very heavily in stocks. Instead, you want to invest more heavily in ETFs. And the reason for that is because some of them are passively managed, some of them are actively managed. But the gist of the nature is that they are a basket of stocks that you don't have to worry about. Right now, the fad is about Nvidia. It's about AI, all of that. It's going to fizzle out, believe you me, right? It's going to fizzle out faster than it got up, right? So how do you protect yourself? You still want to invest in Nvidia, but you have skepticism. You're skeptical about it. So how do you invest in it and not miss out? That's the formal part. How do you invest in that without feeling that you're being left out? Well, let's do an ETF, right? Let's do an ETF that includes Nvidia. And when Nvidia is not doing well, the other things in the ETF are going to help you out, right? So that removes the worry. That removes you from being a super smooth, very sophisticated trader. Just keep it simple. All right, keep it simple and go with the ETFs, preferably index ETFs. So there are a few that we've talked about. Again, I'm not telling you to go out and buy these, but I can say what I have. I strongly believe in the total stock market index, which is VTI. I have hundreds, if not 1,000 shares of that. I have other things like VGT, which is tech, right? Tech we know doesn't do so well in the first quarter of the year, right? So it's getting beat right now. We've got things like VOO, which are it follows the S&P 500, the ETF. Now, these are Vanguard funds. You can get anything Schwab, you can get Fidelity, you can get any funds is fine for as long as they follow those growth patterns. And then you have to have something inside of your portfolio that is also paying you on a regular basis. Think about SCHD, which is Charles Schwab. I think it's a 100 index, and it's very inexpensive right now, especially after the split. I think it's about 27, $28 at the moment. If you work your way up to around maybe a couple thousand of those, right? Work your way up to about a couple of thousand. You don't want to be too heavy on that because that's very, very dividend focused. So even if it's paying you very, very consistently, your portfolio is not growing that much, right? So you want a diversified portfolio, and SCHD is just one of them. That's a dividend paying. That's the income part of it. Then you also want some other things that are growing your account. I'm going to talk about something like, say, MGK, which is the mega caps. And the mega caps are some of those that, like last year, they returned 37%. Mega caps are essentially companies worth over $10 billion. Right? Some of them are worth even what, 50, $60 billion. So those ones traditionally they make a lot of money, but they don't grow that fast. Right? They don't grow that well. Big companies are already grown up, right? Who's growing? Who's growing is the people who are starting up. So the small caps and the mid caps. Mid caps might be a little slow, but small caps definitely they're growing, but they're very risky because guess what? They're also the ones that get out of business very quickly or they get bought out. So you want to have a diversified portfolio, and offline we can talk about that. And to each person is different, so we need to address where are you in your stage of life, uh, what are you trying to achieve, what kind of return are you looking for. But you need generally about 3 to 4 different things inside of your portfolio. You need something that is growing. That's the growth, right? We need something that's income focused, right? Some income focus, that's the SEHDs and all that. And we need something that's combination growth and income, right? Growth and income. And then the fourth basket that we always need is something more stable. So when the market drops like it did, I think Nate was telling us about on October 31, like, when that happens, your cash like or cash based investments don't change that much. They don't make you a lot of money. They just keep it stable, but they need to be growing. So the old adage of 60-40 or something like that, I think that one's out the window now. We need things that, even though they look like cash, they're not just giving us 1 or 2%. They're giving us a whole lot better. So we've talked about things like your money market funds, which last year were averaging on upwards of 5% until the rates started coming down, and now they're right around 4.2, 4.25%. That is still so much better than your bank account, right? Your bank account, if it's paying you very well, I bet it's paying you probably 0.50, if that. Most banks are still paying 10 cents. Is it 10 cents? 0.1, 0.0, I don't know. I don't keep up with them. But your money market funds, right, which are different than your than CDs and all of that. These are only held inside of brokerages. Those are the ones that are going to help you out, at least 4%. So if anything, if your money was only in that at retirement, you're still collecting 4%, and the money is not going down, guaranteed. In fact, if you were, you know, 70 years old and all your money was just in, money market funds giving you 4.2%, you can collect that 4 point something percent and your money is still not going to go down because the value of those funds are always $1, right? It doesn't change. Never goes to 99 cents, never goes to 101. It's always $1. And that's the strategic way for how those funds work. But that's only if the interest rates are good, right? If they're paying well. But that's a very, very conservative strategy. You don't want that. If you're looking for capital preservation, yes, but you don't want to do that for a very long time. You're going to be losing money to inflation. You're not beating inflation at all. right? Because that 4% is only going to remember inflation is what 3% at the moment. 3 point, I don't know what it is. I haven't looked, but anyway, you have to think about inflation and think of the effect. You have to outpace it in order for you to stay ahead. So um, that's not the only strategy you should have. It's just one of the strategies that you should have um, inside of your plan. So again, growth and income. What did I say? Growth and income, and then cash like. So there's four buckets. That's a good all-round portfolio of that will ensure your own survival. That's what you're trying to do. You're trying to preserve your capital. You're trying to grow your capital, and you're trying to get paid all at the same time. So all of that is what you do with the rest of the money that you are not using to trade. So all of that now, if we put all of that together, we have to think different now in 2025 and say, do we care how the market goes? And the answer is no, not really. But we care, but not so much. So in 2025, my plan is to think about more about my actual retirement. When I'm going to say I'm actually going to be retired, I don't know when that is, but I want to position myself or my portfolio to support me and my family much, much better than it is right now. So far it's doing well. It's doing really well, and I'm not worried about it. Whether the market goes up or down, I'm well positioned. I'm already reaping plenty of money from dividends, and that's how I know about it. In fact, in 2024 is when I realized and I saw all this cash coming in from dividends. I was like, what, this is a strategy by itself. And that's what led me to pay more attention to it and said, I don't have to work as hard as I am working. I don't have to trade every day. I don't have to do just grind every day. I can let this market work for me. That's when I realized, when I rebalanced my portfolio, that the dividends were actually paying me plenty, pretty penny every 15th of the month, every uh, first of the month I got paid. Shop is now paying monthly on the last day of the month. Some of them are paying every quarter, every 3 months. So when you average all of that, I found that my portfolio is just growing tremendously without me doing a whole lot. And this is all the money that I don't use to trade every day, right? The only amount of money that I use to trade every day is the 10K that I told you about, $10,000. That's the total exposure. So even if you have a lot of money, I keep saying this over and over again, even if you have a lot of money, it doesn't mean that you should trade that every day, right? The market can smell that money and it's going to come for it. Yeah, they'll come for it. So just hide it from the market, so Big Brother doesn't know about it. Uh, so that's the plan, and there's plenty of ways to do it. So the question now is back to what we do every day, and I'll take questions by the way about that long-term plan. Back to what we do every day is, how do you go cautiously, right? What's a good size number of contracts? What's a good amount of money to play? So we're talking about 10,000 here. Does everybody need to play 10,000? No. No, you don't need to play 10,000 every day. Instead, what you could do, and the safer thing to do, obviously the lowest number of contracts that you can trade is what? One, right? But what will one give you? One will probably give you 40, 50, $60. Uh, is that enough to build a bank? I don't know. If you never spend it, maybe, right? But our plan is to grow from making that 50, $60 to putting a zero on the end, to where you're making that 500, $600, either on a regular basis, like every day or every other day, something like that. That's the plan. So what kind of strategy can we adopt to give us that? Successfully, we have found that spreads will give us that. Selling, right? Selling. Others have found that buying spreads is giving will give you that. So we're talking about the debit spreads, and those are really easy to execute on S&P 500. In fact, they are less risk than selling. It all depends about what you're comfortable with, how good you are at getting the direction correct half the time, not all the time, half the time. And then there's calls and puts, which in the spectrum of risk have the highest risk, right? They are the basics of trading, but they have the highest risk. So remember that even if you buy a call for, say, $1,000 on SPX, your chances of success, are high if the market is going in the direction that if it's going up, if you bought that call, right? But if that market turns around and you blink, that thousand can go very quickly from 1,000 to just 100, right? You can lose it very, very quickly, especially if you trade that in the morning when there's high volatility. And within 10 minutes, if you're in the wrong direction and you do not get out, you didn't have a stop loss, $1,000 is gone in no time flat. We don't want that. But the thousand can also make you 1,000, right? So that's why that risk factor is there. Anything that can make you a lot of money can also lose you a lot of money. Do we want that business? Personally, no. Right? I want something more stable. I want something that is that I can be more calm about. And that's why I favor spreads a lot, especially selling. Debit spreads are number two way to go. Number one is credit spreads. So I can sell, I know my profit up front, and I understand that for as long as the market stays within a certain point or below or above or whatever it is, I've locked in that initial profit. And now to lock in the net profit is just close the position. That's it. Right. I don't care. Does it need to go a whole lot? No. All I need is to stay below or stay above that point. If it's a CCS, I need to stay below. If it's a PCS, I need to stay above. We all understand the concept of spreads, how they work. So that's what we do. That to me is easier to do than getting a call and now hoping that I hope it goes up. I hope it goes up. Oh, it's coming back down. Is this the time to get out? Or I buy a put, it's going down. By the way, that has been going on a lot, but you can see based on the graph, based on the charts, it's been all over the place. It's going up, it's going down. What do I do? Is it moving enough? On some days, it just doesn't move at all. Friday, yesterday, right? It was a doji, ended up a doji, went all the way down, went all the way up, um, and then right where it stopped. Well, right where it started. So we can see that the calls and puts maybe not so much, but if we do a spread, we sell something, at least we can count on decay over time. We can count on at least some movement decaying the spread. So I think that's a win-win situation. The risk is just there, and we just have to deal with that risk as we've learned how to do that. So 2025, my number one way is to go with spreads or continue to go with spreads. I have increased my spread size from or width from 5 to 10. Previously, or for many years, I have done a 5-point widespread. I am now doing 10-point widespread, and that is seems to be working. There's several reasons why I think that is a little bit better for me because the reasons are one, I get more premium. So number one, there's more risk, but I get more premium. And number two is that it's to me, it just seems to be marginally decay faster, right? Marginally decays a little bit faster. There are a few other things that I like about those 10 points, that we can go into on a technical basis, but that's my new go-to. So I'm doing a lot of spreads, uh, and I'm liking it. So I'm also trading less, right? Remember a few years ago, I was trading very, very heavily every day. I went down trading just a few times a week, less contracts. This year, I'm actually trading a lot less, right? A lot less. I'm concentrating on things that actually make me more money over the longer term and less worried about my income strategy, right? And that's because I've got all these other things paying me very, very handsomely, so I'm able to relax a little bit on the SPX trading every day. That yeah, that can get old, but I'm there. I'm there in the market almost every day, but I'm just trading a lot less. So, uh, what else am I doing for 2025? I'm at the point where I've loaded up on a lot of ETFs every month last year. Net, when I do my math at the end of the month, I have allocated to my portfolio the different baskets that I talked about and seeing which ones are paying me the best or which strategy do I want to concentrate on this month. And so I have gone onto and I'm going to open up my okay. So I'm very, very concentrated in tech. So my QQs and my VGT are heavy. Those are the heaviest that I have on my portfolio, right? And those are taking care of my portfolio growth. So I'm very, very heavy on those equities, and they are consistently growing the portfolio. So that's the growth part that I want, and that's my path to getting to about maybe five M or closer to that, maybe 6M, I think. So that's where I want. That's my target. That's where I want to be. And then I have got my income, which is on the VUG and the SCHDs. That's that's what on the VO and the VYM. VYM and SCHD are about the same. I prefer SCHD, which is the Schwab. Schwab, by the way, the SCHD that I'm referring to is called the Schwab US Dividend Equity ETF, right? SCHD. So I am committed to building at least 5,000 of those shares. And we are at just under 2,000 shares on that. And those are very cheap, by the way. They're $28, right? $28. You can get there very, very quickly, or give yourself a little bit of time. So again, I want to focus my portfolio on things that pay me well on a regular basis, and I want to focus on things that grow. So the things that grow are actually usually more expensive. VGT, for instance, the price I think is 627. That's the most expensive thing inside of my portfolio per share basis, and that is VGT. The next most expensive is VU, and I probably need to. Well, I'm actually not gonna trim that. It has done extremely well for me. And then there's VTI and MGK. All those are over $500, over $300, so to speak, actually. The more expensive I have found an ETF, the better the quality. It's kind of goes with the all, but not necessarily. That actually might be a sweeping statement. Not necessarily because SCHD is actually $28. So and that's not a bad thing, right? So I avoid the mid caps. I prefer large and mega caps, and I prefer dividends. So that is what my portfolio looks like for 2025. Let's see what kind of questions or strategies are you guys thinking? Anybody's got some thoughts? My take on bonds. I don't like bonds too much, right? I know bonds are designed to protect you. To me, it's like putting your money in a sack, taking to the bank and tell them, just putting these in the lockbox. That's my opinion, right? Maybe a crude analogy there, but that's the equivalent. You put your money in a suitcase and you take it to the bank. You don't open an account. Instead, you open a lockbox or a safe deposit box. Do those still exist? I don't know. Maybe I'm dating myself over here. Young kids over here might
They
not know
do.
about.
They
Yeah,
still exist.
yeah. Safe boxes. Uh, a safe deposit box. That's what it is. So you put your money in a safe deposit box, and then you come back 1 year later. Guess how much is going to be in it? It's going to be the same amount. You've probably even forgotten the combination. So to me, that's bonds, right? They don't grow. Instead, what I do is I will invest. I'd rather invest in something like VYM or SCHD, and the reason is those rarely drop in value. In fact, if we look at the chart for SCHD, I'm going to bring it up over here in a second. Now you can bring it up on your side. SCHD over a period of say 3 years. Yeah, it's basically flat. It hasn't moved. I just looked at it in 5 years. It hasn't moved, 2 inches on the graph. Hasn't moved. But do I buy it for price appreciation? No, right? I don't buy it for price appreciation. I buy it for the dividend. And it is very, very, very consistent. Over the last 20 something odd years that it's been in existence, that has been proven, and I've done the research over and over again. It is a good stock. Schwab, by the way, is one of the best brokerages here in the US. They're one of the top. Uh, and SCHD is widely known. Just Google SCHD and you'll find. By the way, they're not paying me for all these mentions, so this is not a commercial for them. But for me, that's my bond equivalent, right? That's my bond equivalent. So when I say I'm putting money in cash, I'd rather be buying that because it's paying me dividends. And I would prefer that over SWVXX, which is the money market fund made by Schwab, paying 4.2%. So, yes, that one does pay 4.2% every single month. And it's a weekly yield. So that changes every week. But even that 4.2% yield every week does not beat the SCHD, which is 12%, I think, a year, give or take. So if you do the math and see if you invested in SCHD versus put your money in SWV, which one would do much better? The SCHD definitely much better. If you wanted to talk about capital preservation, the SWV 100% is going to preserve your capital much, much better because it doesn't change. But then the SCHD doesn't fluctuate that much either. And in any case, your strategy is not to buy and sell. Your strategy is to buy and hold and preserve that capital and let it grow in a healthy fashion at the same time. So it's a long-term plan. It's a marathon. It's not a race. Is that what they say? Not a sprint, something like that. So take it easy, take it slow. That's my plan for 2025. I want to finish strong.